I want to pitch up on Mohammed's line, and welcome to the program, sir. The notion that inflation is dead, this notion that we are mission accomplished, came way too early. Might you agree with him?
No, I don't, right? Jonathan, we're paid really in this business to look for different paradigms than the one we're in. A lot of people this morning after Friday's, really strong jobs number are kind of jumping back on the strong growth, high inflation narrative bandwagon. And, there are other scenarios out there. Like I said, this is very difficult, right? Forecasting interest rates and even the path of the economy are always difficult. Today, just as much so. I mean, just look at the climate risk we're facing in the last couple of weeks in this country, right? I mean, it is a tremendous destruction of wealth, but it can also be inflationary. So you have a tug of war going on just from that one exogenous effect that we're seeing increasingly around the world. But there's this scenario, Jonathan, that prices stop going up, right? If prices, which are high across a lot of different categories, just stop going up for a year or two, inflation goes to zero, right? And that is a scenario that we're actually starting to put a little more weight on as a risk scenario that, heck, maybe these 0.2 and 0.3 inflation prints, which we're expecting later this week, turn into zeros and 0.1s, and then you're running at year-over-year inflation below 2 in 6 and 12 months from now. That is not at all out of the realm of possibilities. And in that world, rates are possibly 100 basis points too high. So I know Torsten Slok is painting a picture, maybe rates are 100 basis points too low. Maybe they're 100 basis points too high. And it is really difficult. But as investors, as long-term investors, you have to take into account all of these different scenarios.
Well, Mike, that's what it takes to make a market. Two very different views. So let's run with yours. We've got a 2-year right now that's reset at 4. The whole curve has reset higher in and around 4%. What do you do with this morning?
Yeah, I mean, we're advising our clients, and in fact, in our portfolios, we've gotten a little bit long duration, right? A month or two ago, when the 10-year was pushing down at 360, and there were tons of rate cuts priced in, it seemed like a little overdone in the near term. And I know we've spoken about that. And we were advising clients, hey, if you ever get an opportunity to buy the 10-year, in that 4 to 4.5% zone again, don't miss it this time. Take advantage of it. And right now we're right at the bottom, of that buy zone is what we're calling it, right? And I think, investors are probably going to take another bite at the apple here. I mean, we've seen flows coming into public fixed income in a pretty big way. They actually accelerated recently with the Fed's 50 basis point cut and with a slowing in economic and inflation data. And I think maybe investors this time will be emboldened to take advantage of this backup in rates and add duration. And I really think over the longer term, that's the right thing to do.